everyone. This is Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey, and today we are joined by none other than Bill Dallas. Bill, thanks for being here.
Jazz hand.
Yeah, that's really nice. Oh my God. All right. So before we get into the crux of things, I just want to remind everyone that if you are in Thousand Oaks this week on Thursday, that would be May 15th. Join us at Greater Ventura Camp's Lender Fair. It's a great event. So
what date?
15th.
Oh,
Today's the 13th, so
that would be Thursday, the 15th. Okay, I think I already said that. Moving right along. We are part of Crispin Commentary's little lineup, so make sure you're checking out their other offerings and reading Rob's what do we call it? Commentary. Hello, every day, because you will get a lot of great information from there. With that being said, tomorrow it's a big week, always a big week. Before we talk about today, we'll talk about tomorrow, where we have Fed speakers all over the place. We've got Christopher Waller, Philip Jefferson, and Mary Daly all speaking. We know that the press hangs on to every single word that everyone says and then write some titillating headline that will freak out everyone that you know and all your referral partners and clients. So make sure you're paying attention to what the actual truth is. We'll fill you in as much as we can. Thursday, we have PPI, that would be Producer Price Index, and retail sales, along with good grief, initial jobless claims. And on Friday, we have housing starts and permits. So with that being said, we're going to start today with Consumer Price Index, which came out this morning looking relatively benign, and mortgage bonds have tanked yet again. So as we are coupling that on the heels of China and the US, at least for the moment, playing nicely in the sandbox, bonds are taking a hit as stocks are doing better. So, Bill, any comments?
So yeah. What's interesting about this equilibrium, right? You would think sometimes, like mortgage people think, that the direct opposite potentially of a stock market might be, the bond market improving. And I think I've been pretty resolute in saying, look, this is going to be a challenging market for interest rates for a long time.
Yeah.
Right. I don't
long
think
term, like how many years?
I think people are getting used to it, but I think it's going to be with us for a long time. I think you could maybe get in the fives at some point, right, over the next 18 months, but it would take inflation to be almost rampant. It would take I think you're getting it is interesting, and with the Trump administration, right, it's almost like a fog screen, right, to the market, because there's so many things happening that people just, it sort of moves. And so I don't really give a shit about the what I'm going to call the stock market, other than, hey, if you own a few stocks, then great. But I still follow my old company, Finance of America, so it's rallying, so I'm happy there. But the rest of it, I don't think it matters. So I think for us, I think a couple things. I think you are going to get, over the next couple of years, an increase in originations overall, and that's a good thing. I think, however, where we were talking, Audrey, and I think with you and Kevin, I think, and I've tried to say this to people, I think if you look at the shifting landscape and said, okay, I'm trying to strategically figure out, as a loan officer, as an originator, as a realtor, as a contractor, as a flipper, as whatever you are, right? Things have changed. Yeah. And you are in a different environment totally than you were coming out of, really, you're actually a little closer to 2018 and 19, than you are to what you've just gone through. I would say forget this shit from 20, 21, 22. We had COVID, we had all that stuff. Just throw it out. Yep. Now it's mesmerizing, the Fed a little bit, but the economy is pretty good. Real estate is a problem. And the problem is that it's, look, to buy, you've had the fires, you've had really, I think now this frozen tundra on the top end, that because people are freaked out a little bit about their stock market, their investment gains, blah, blah, blah. But I think overall, I'm going to say that you're going to be in the between 5.5 and 6.5 for the next 18 months. And that means you better have other than conforming products.
Thank you. That is literally going to be the gist of what we're talking about. And that actually coincides with what Fannie Mae has just released, which is they're expecting 2025. They've revised their projections up for originations for 25 and for 26. So 1.98 trillion in 25, 2.33 in 26. Those are up slightly from previously, and they are expecting rates by the end of 2025 to be at 6.2, and at the end of 2026 to be at 6%. So that, by the way, is really in line with what the general market is expecting. Nobody is expecting a huge drop in interest rates at this point. So
it's going to be, I think the good news for loan officers is interest rate volatility is going to be at a high. So that will affect borrower behavior and investor behavior, because I think you're going to have to price, and you're going to see this, you're going to see pricing up and down. And so I think any loans that you actually get in application will probably fund because of the volatility, and people will lock quicker, blah, blah, blah. I think if you look at interest rate volatility, I think would be the headline. If I said, what is a shifting landscape, it's going to be interest rate volatility, probably a housing affordability crisis. So you're going to have to really have solutions that are different than agency. Inventory shortages will abate. But I think you're in this renovation, down payments. You're in this whole time where America is older and our properties all need to be redone. Right. And we're different than Europe. We're probably, the average age of the US home is probably 50 years now. So from lighting, solar things. And I would say in California, especially, but I see it in many states. I think this movement for us to have solutions for insurance and how we are going to underwrite is probably going to be one of the biggest changes. The underwriting for maintenance and utilities and insurance. And you're already seeing it probably I know in a couple offers that we've made it contingent upon getting insurance and not just something else. Right. So I think that's interesting. I think really the market share rise of the independent mortgage bank and mortgage brokers is huge. I think retail mortgage banking is suffering. Consumer direct is suffered. Although, look, if you have a shitload of servicing and you're Rocket, you can just keep calling your customer and keep them in the pen a little bit. And then I think really the challenge is, I'm not going to call it non-QM. I'm not going to call it technology. I'm not going to call it all these things that we all talk about, digital, blah, 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 and all of that. I think home finance needs to be built for modern buyers.
Yep.
And it is not.
It is not.
Fucking archaic. It is almost prehistoric. I'm going to go back to, there's dinosaurs and there's things flopping along and we're doing this. I mean, I don't get it, but I think this super bloom that you're sort of getting in non-QM, non-agency, and almost, non-agency jumbo is just sort of gone.
Yep.
And now we need cash out. We need renovation, right? We need debt consolidation for sure. And then you've got to have first-time home buyers. You've got to have some products that allow first-time home buyers other than just FHA, DPAs. So all of that has to happen. And then if you really look at it, right, the things that I've been pressing on, whether it's like you guys and I, we've talked a little bit about HEI contracts and some of the things that I want to talk about, but home finance needs to be built for entrepreneurs, first-time home buyers, homeowners with lots of equity, new construction and renovation, second homes and getaways, buying with friends, co-own multi-unit, added dwelling, fixer uppers, protect the house a little bit, fix it up, go green if you want to. I mean, all those things, they're all niches, and they're all little things that the standard primary occupant, owner occupied purchase investors that we have just don't fit.
They don't. Although one of my greatest joys in the business at this point is so many of the borrowers that I would have had to throw away years ago because there was nowhere to put them. That isn't the case anymore. There are a zillion other options, and that's what we've been really driving home here for a long time, because I pivoted, and most of my business is non-QM and private money at this point. I do obviously I do conventional. I can do it with my hands tied behind my back, but most of the time that's not what fits, and it's not even the best pricing. And I was reading that I can't even talk. Demand for second homes is way down, like the lowest since they started tracking it. And it's a third lower than when we were going through the pandemic. And there are many reasons for that.
Well, one is
Obviously,
Fannie Mae
the work from home thing has shifted. I mean, people can't live anywhere anymore and still have the job with a higher pay, but also the LLPAs from the GSEs, that is really, in my opinion, had an impact on second homes.
Yeah, I would say, the thing I would try to lift loan officers out as we do these things, podcasts and discussions, is okay, think bigger. So what has changed? Let's just go to, we are tethered to the government ball, right, of Fannie, Freddie, and Jenny to some extent, right? So everybody talks about the guidelines and the rules, and those things have been around for a long time.
Forever.
So when you look at what has shifted, it's really the owner occupied primary occupant SFR that's gone, because the single family residence is, I'm going to say it again, multi-use right now. So we think about it as an owner occupied dwelling, and what we should be thinking about is it's so many uses. You could ADU it, you could rent it, you live in it, you occupy it, you all the things, you office in it. I mean, it's your office, it's where you live, and it's multi-generational to some.
Yes. But
all those guidelines none of them fit in agency.
That's right. So aren't you seeing a shift back to the office? Because I sure am. I mean, state of California, which I think would be the last one to do this, is just mandated that all their employees have to be back in the office at least 4 days a week by July. Federal employees, obviously, back to the office. My son's in tech in San Francisco. They all want to be in the office. They don't want to be working remote. It's actually a deterrent for some people on whether they take a tech job or not, because they understand that collaboration. And when you've got younger people who aren't satisfied with what they are doing, well, there's no connection. And if you think about how all of us dinosaurs learned the business, it was because we were in an office and we overheard 500 conversations a day.
Or you walk into someone else's office and said, hey, how do you do this?
Everybody else's scenario was your scenario. You learned through that. And then you had reps coming in and telling you about different things. And that just doesn't exist. Like, someone sends me an email, I don't even open it. Somebody calls me, and which I so appreciate, because it's such a big gesture these days. But even that, I don't know them. I don't know if I can trust them. I don't know where they live. I don't know anything. So even that's harder. And so I think that for an older group of loan officers, it is going to be get them back to the office because they're so comfortable and they don't need the money. But for other people, I think to learn the business, to create the momentum, to have some sort of community, I don't know about this working.
Well, I mean, when I trained realtors or mortgage people, right? You can, if 20, I would say 20% of it is product knowledge.
Yes.
Obviously, you can put deals together and do a bunch of things, but only 20%. 80% is selling skills. In order to help somebody develop selling skills, I've got to put them on the hots. I've got to get them in front of a client. I've got to mentor them and actually take them out and sit them in front. I mean, when I used to do it with realtors, I just walk down the street and say, knock on that door. Let's see how you do. Because they'd freak out.
Yeah, I bet.
right? And I think it's the same. If we are, look, you've now had this if we're going to do this tidal wave of AI things and everybody's trying to figure out how to digitize, and the challenge is the customer experience at point of impact is still trust.
Yep, 100%.
And you can, and I want to stay in contact with the client. I want to do all those things. So you can use technology to do all those things, but it's very hard to mentor, grow, and develop, younger, I think newer, neophyte-ish LOs if you can't have them in the office and take them out and show them things and go and do events, whether it's a realtor event or you're at Chamber of Commerce or you just go to camp. I mean, I need to help them understand. And I think we've got a lot of modernization that has to happen. I see it, like you said, I mean, if I'm in Utah, I was in Utah last week, everybody's back to work. There's more cars in things and everybody's going to lunch again. I mean, it looks like normal, but if I go to Minnesota, it's different, right? So I think in California, because of traffic, we've always been weird, right? About how can we get to the office and what do we want? I think, and in non-QM, the non-QM lenders are all in the office, right?
Really?
I mean, they because there's a lot of collaboration that has to go on with respect to underwriting guidelines. Everything's different. And most of these folks are shifting out of agency,
right,
to some extent, right?
Blend.
Yeah. And so I think I throw it as modernizing mortgage. I hate tech. I hate all these things that we talk about. We just need to modernize the whole thing.
It's interesting. With the tech conversation, it's interesting because I've been saying this to regulators for years. Show me the ROI on that regulation. Show me how that really is helping someone versus how much it costs for an entire industry to implement and then enforcement, et cetera, et cetera. Same thing with tech. I'm hearing a lot of conversations now because there was so much pushback by people saying, I'm going to lose my job, so I don't want tech. Now they have adjusted their messaging. They've got some marketing people in on this now. And they're like, oh, no. You're not going to lose your job. We're going to free you up to do other more important things. So the other day I'm listening to this podcast and this guy's talking about how they're training AI to read a purchase contract. And I'm like, I wonder how many bazillions of dollars that cost when I need to scan it anyway, because I've been told at the regulatory level that I am responsible for everything in that file as a human, regardless of what the computer just spit out. I need to make sure I've got the terms right, which takes me 3 seconds if I'm a seasoned LO to look. I know where to look on a purchase contract. Where do I find the purchase price? Do we have any
first page?
Where are we looking? God, Kevin would look at there might be something on an addendum. You might want to be aware of that, Kevin.
No, it's all on the first page, first paragraph right there.
So my point is, when we are looking at tech, I love tech. I have a kid in tech. I talk about tech all the time with him. I think it's great, but we've got to really think about where are we putting our money, because it's all on the backbone of borrowers. And the more we commoditize this business and, ramped up the tech, look at the cost of our loan to produce.
Well, you look at the companies that are uber successful right now, right? And I'll say it's United Wholesale, probably Rocket to some degree. I mean, and then you can go through the public rent roll of Guild, I'm even going to say Loan Depot, and just boom, 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 right? And then you got PennyMac, Freedom, some of these companies that all sort of sit around the rim that are more correspondent, right? They're not really lenders.
Right.
Correspondent people sell stuff that we already have and give us the servicing and give us the servicing value, right? It's like, I don't really get it. So I think the conversation, I think two things are going to happen. You have the invasion of Wall Street now back into Main Street. Now that was fully unbundled along with the broker and the bank in 06, 07, and 08. That group is all back. It's almost like the party I was watching the Sean Combs, P. Diddy, Puff Diddy bullshit thing that's going on, right, with his and his white parties, right? It's almost like these white parties are coming back into the mortgage business. And if you go to a non-QM conference right now, it is off the chart. It's exciting. There's lots of conversations. I think two things have happened. So if you have that invasion, which you're going to have, that means that more and more of your product mix will go to non-QM, non-agency, which is probably a good thing. If Fannie and Freddie get cut loose, it's all non-agency.
Okay, couple things. First of all, when you're talking about the top lenders, the ones you mentioned, guess what they're known for? Vanilla, 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 throw it against the
Agency.
wall, see if it'll
Yep.
stick, but if it doesn't, who cares? So, and then conversely, what we're talking about, what we really need is we're doing loans that are difficult. Everything's got hair on it. They're not easy.
No,
And
no, I had one of those yesterday. In
they're
fact,
every
I
day.
told the client, I go,
every day.
I got bad news and good news. Like, oh, this loan's super complicated. The good news, I do super complicated.
Yeah,
Nobody else
I'm your
does. So,
guy.
Yeah, exactly. I had a big deal that went into contract a couple weeks ago, and if I didn't have non-QM, I had to flip it to a DSCR the day after we went into contract because the borrower, the information the borrower got me after they went into contract, but I had another option. But again, so these big companies where they have these very, very efficient systems, they're fine. If you're doing an A paper, vanilla, W-2, fairly simple. I know guys at retail banks who closed tons of deals who will not do a loan for someone who's self-employed. They won't even look at the application.
Mhm.
So
some lenders won't even touch it. There's not less than 20%, or there's less than 20%
yeah,
down.
exactly. So we've got some pretty lazy, greedy loan officers in this business, and they are only they're cherry picking the easy stuff. And that's why, like, I'm not praying for the rates to get to 3% again. It's going to have this whole influx of greedy jerks who were doing something like, I don't know, I won't even disparage some company, but working somewhere else at some low paying, low end job. They come into the mortgage industry, they take all the easy stuff, they make a ton of money for a little bit, then they go crawl back into whatever hole they came from, and there we are. So, I don't know about this. I don't know. What do you think about all that?
I think you're right. I think the seasoned look, it's a business where I think I was giving somebody the stats on LO productivity. It's less than one loan per LO. Industry wide.
Yeah.
Okay. This is frightening, right? So if you're a big company and you're 0.87 and you got 2,000 of them, how do you improve? Well, I think distributed retail is on the bubble because of its cost. And because of its the cost to produce is so high.
Distributed.
Because
what is distributed retail?
Branches. Real branch systems versus consumer direct.
Okay.
So you're distributed, right? You're everywhere. You're in every corner. You've got a branch. You've got a posse. You've got underwriters. You got LOAs. You got all these people that are in there, and you're doing about 0.87 loans. So none of them are profitable, right? So and then there's guarantees. There's people who are actually doing business, and then there's this broker movement where people are moving to mortgage brokerage because the price is better. Why is the price better? Because you can't charge enough in distributed retail to make money if your cost to produce the loan is $15,000 a loan.
Yeah.
Right.
It doesn't cost Audrey or Kevin $15,000.
No.
You got like you, a dog, a cat, and a few people, right? So I think what happens is this is happening, right? Wall Street's invading. So you got all these product changes. And then you've got this, what I think independent mortgage bankers have a 70% market share. They're going to orphan it because they're not going to be able to sustain it. The broker is going to pick up speed. They're already at 25, maybe 30, 40%. And they're going there for price because there's lower cost. They have more control. And oh, by the way, with the CFPB on the sidelines or in the penalty box, you can do more. Right? You can do more with your referral partner. You can do more with your deductions. You can do more with marketing costs. You can do more. Whereas the bigger companies are still, mired in, I think, a compliance nightmare. Right? It takes them a while to actually figure that out. Although I would have said, probably the biggest headline is you would have never seen a deal from Zillow and Redfin in last year in a prior administration.
Well, okay, so there's a few things there. So number one, there's a 5-year look back for all of the regulatory stuff, at least. So everything that we're doing today, somebody could come in 3 3/4 years and upside down that all over again. So so that's always in the back of my mind, right? But also Kevin and I are hearing from brokers who are really struggling because just because you know how to do a loan and you want a lower price doesn't mean you're good at running a business. And the narrative for a few years was everyone can be a broker. Everyone should be a broker. Why aren't you a broker? Brokers are better, for God's sake. And what we have found is that there are some places that we stay away from naming that have made it so that it's very easy for someone to become a broker, but you better send all your business to them. And that's not being a broker at all. That is being a retail division of a IMB. So it's complicated, and I don't think that there's one set way right now. But to your point, the efficiency, the number of dollars that are spent on a given transaction, all that does matter for sure. It's
but I'm finding in talking to brokers, like the broker of the shop, that they are trying to cut costs everywhere they can, and the biggest costs they're running into is the shop itself. It's like, we can't do the overhead on this. Like
the fixed cost. Look, just the same. I agree with you, right? Because the branch, if you have to have a distributed branch, and you have to have all the sundry things that go with it, from front desk to LOAs to processors to maybe an underwriter to marketing people to then you have to hook. Look, I basically spent my life helping as a broker, starting as a broker and helping mortgage brokers, whether it was First Franklin or Ownit. We were 100%, TPO, just a broker as my client.
right.
And I think you're right. If I took a curve of, let's say there's 5,000 of them, right? And I took that curve, very few make a ton of money. There's early adopters, late adopters. There's people that make money. There's people that don't. There's people that are very seasoned. There are people that are consumer direct. What I like about it is they're all over the place. There is not a cluster. And I think what happens, as we sort of go through this metamorphosis in mortgage, this shifting landscape, which is, you feel it. It's almost, I can feel it rumbling under my feet. And what happens is every client I have is in some stage of cost cutting or losing money in something.
Everywhere.
So, and we want to modernize mortgage, so we have to invest in it, or we have to go do something new, or we're looking at something else. And I think the model is in question and we need to make a change. I'm not sure what that change is, right? But it is shifting. Right. And I think that will create the changes because everybody's going to have to try to solve for it.
Right. Yeah.
In some way.
You can't avoid it because your bottom line won't allow you to avoid it.
Yeah.
Kevin?
And the public companies just have to figure out whether they outsource it. The challenge of bringing all of these costs, like you guys said, you want to fix mortgage. Well, if I would say out of all my clients, if I looked at their repurchase requests and the loans that they've actually bought back, they're all disclosure issues or some other bullshit. The client's paying. They've either messed up the DTI. There's some appraisal knucklehead thing. They didn't do the disclosures right. It's like, really? Yeah. So,
and who cares? It's like, it's minute issues.
And the reason it gets put back is because those rates were at 4, 3, and 5, right? So here, what I hate about mortgage is the toxicity of we sort of throw the baby out with the bathwater from a disclosure and a compliance standpoint when the loan is good,
Yes.
right?
Yeah.
And doesn't make any sense. Then as an independent mortgage bank, I'm not a depository. I have to go sell the stupid thing or own it.
Right.
Just keep it and try to prop the payment up or do something, right? So I think there's independent mortgage banks have that issue, hospital lines, how they do it. And because we have to bank through banks, we're sort of one step removed. The second issue is we don't make more money per loan at all, right? We need to make more loans. The only way we make it balance is by making more money, is making more loans. And so I think what we have to do is we have to somehow synthetically do more revenue per loan with other services, which is another compliance problem. How do I compensate loan officers? What do I do? Banks don't have that problem.
Mhm.
Banks make a shitload of money just on depository, just the rate difference. If they want to do credit cards, they do credit cards. If they want to do this, they just do that, right? So and so do credit unions. So I think we have a natural inhibitor for how we're competitive. The good news for us is we are 24/7, 365 into mortgage finance every day. Now, how do we, because my two saving graces would be, we need to make more. We don't need more loan officers.
Correct.
We need loan officers to do more, and we don't need more loans. We need to make more money per loan, right?
Well,
As a
here's the-
company.
Okay, Bill, chew on this one for a minute because this has been percolating in my head too. So as we have become more and more commoditized, as we have had Wall Street become a more integral part of the mortgage business, as we've seen more big companies go IPO, now they're answering to investors and shareholders, et cetera, right? So what do they want? They want growth. They want more money, more. So there's always this need. Back when I started in this business, I mean, my God, you got in, you closed some loans, you were doing great, had a great living. I mean, it was so not so complicated. It was much simpler, and there wasn't this constant voracious need for more money and more growth and more, we become part of this monster, and the borrower gets lost in that. Because again, if you've got, somebody who knows what the heck they're doing, you're going to be in much better shape as a borrower than you are if you're working for some machine who has created a box that is part of a system so they can spit you in, spit you out, and you move on and make a ton of money. And so have we lost our way is what I'm starting to wonder.
Well, and I think we've lost it, right? Like I say, I feel this shifting now occurring. I've always said that, a crisis, never miss the opportunity in confusion or in a crisis to make a change.
Yes.
And I've always used this, and I think I've said this on there before, right? If you really want to formulaic it only happens with individuals or people or companies. C equals FDR. And think about the president, Franklin Delano Roosevelt, right? So FDR. So change or crisis or confusion only happens when fear, dissatisfaction, and resistance to change are so broken down that people say, take me.
Right.
Businesses said, take me. So what's happened in mortgage over my lifetime is, and we have really messed this up, and so have the agencies, is we've unbundled origination and servicing. The companies that are doing well have plenty of servicing.
Yes.
They've either bought servicing, and what have they figured out? We cannot, most of them struggle with, I would say most of the public companies that are retail, I'm going to only, right? Mm-hmm. They're not growing their servicing book. It's shrinking. Their servicing book came from COVID.
Yeah.
When everybody booked servicing.
And then they sold it to make ends meet.
Everybody's selling service. Everybody I met is selling servicing to make ends meet.
Yep.
Right. Yeah. And then you've got probably the biggest aggregator of servicing just sold to Rocket.
Yeah.
In Mr. Cooper.
Right.
Right. That's Nation Star. That's Nations Bank. That's Mr. Cooper. What a screwy name. But at the end of the day, that is they have figured out that there is really, it's a very difficult business. I'm going to call it now what we call it, right, in mortgage, these MSRs. So we have MSR companies who, and I'm going to throw PennyMac, Freedom to some extent. These are FHA guys. Then you got Bayview, and then you've got people like Rice Park and others that just buy MSRs in general. The worst thing to happen to mortgage companies and the worst thing to happen to an originator is I sell the servicing. Because now I have a compliance problem. I have a contact problem, right? And I don't have my client. My client is over here in some la-la land with somebody else, and I have to convince them. And we also see these problems during forbearance, delinquency and default, foreclosure problems, where the trusted person like Audrey and Kevin aren't in the saddle.
Right.
The client's stuck over here in MSR land.
Yep.
And then what we've done is, because servicing is the compliant nature that they forced people into servicing, forced everybody out of servicing. So you have these big subservicers that sit between us and the servicer and the investor.
Right. And then our biggest competitors buy those servicers.
Every day, every time you sell your loan, you sell the client.
That's right.
And that part of it's just a fact, right? And I think because we don't have prepayment penalties, the loans don't last.
Right.
So we have this volatility of what the MSR pricing is. And I think we have to somehow conjoin that business again, whether it's artificially, but contractually, because I can't have an LLPA that precludes me. I can't from contacting me from my client. It doesn't make any sense. If I'm a broker and I'm a full-time originator. So those things are just wrong. And there are ways that you can bring it together, but trying to price it, you can't price. I mean, you have to price in order to get a loan today. You have to price the MSR into that, or you're not going to even be competitive.
Exactly.
Right.
So I also find it interesting from my point of view, where today I am literally getting phone calls from my clients who are asking me about refinancing because they hate their servicer.
Yeah.
The big guys. And I'm like, okay, we can't do that because your rate is so low that makes no sense. Conversely, a million years ago, I had clients that would come to me and they would refinance, or they'd be buying a new place. They're like, I love my servicer, Countrywide. They had great technology. They had a great online mortgage, website that people could use. They were like a front runner with regard to the technology. People loved their servicing, but they didn't want to go to them directly because their rates were higher and they sucked and they couldn't have me. But I could figure out a way to go behind the scenes and get the loan sold to them on the back end, right? So back then, people are begging to have a certain servicer because they were great. And now they're begging to not have the servicer they have because they suck. So that's a technical mortgage term, just for the record. Like we have really, again, I feel like with all this advancement, all this money that has been spent, all these changes that have been made, what have we accomplished?
We basically made, we took a holistic, better relation. Let's say a deposit. We start with banks and S&Ls, right? And maybe credit unions. And we have this depositor relationship that I deposit, I can walk over there and get my money. I could get a loan there. I could do all those things. And then we've truncated origination of products because the bank either didn't want to do them or they weren't really good at it or whatever. And each of these people, I don't care whether you're peer-to-peer, fintech, SoFi, right? You got all Figure, you got all these things. And then you got mortgage bankers who just took the mortgage business. And I think we have to figure out ways to rejoin it, because the customer mortgage, if you think about, there's a company that I like that and one of the people say, well, what do you do all day? I basically try to fix this shit and try to find super blooms and people who are doing it that I can help. And then, so one of them is a small company called Haven, and I love Haven. You know, it's spun out of what I would say would be a traditional Northern Cal, Stanford-ish type, you know, where they took this problem that I just said and said, we're going to build a platform that sits on top of a servicer and the investor, so that a client and the broker and the originator can stay connected. Simple. And, oh, by the way, sell them other products.
Haven.
You know,
All right.
insurance or some other product that's there, right? Whatever, knock yourself out. But I think absent things like that, it's very difficult to find where change. So when your dissatisfaction and your fear and your resistance to change gets so broken down that you say, holy shit, we got to change. I mean, and that is almost where we are. We're close, right? We're close right now.
So it could break out either way though. And that's what, so I go to a tech conference and I hear guys up on the stage who have never done a mortgage, had a mortgage. They've never sat in front of a consumer. They have no idea what a borrower wants or needs. You have people who are in these higher level C-suite positions who haven't talked to a client in a zillion years, and they think they know something, and they're so disconnected. And I worry for the borrower.
Yeah, that's why I say, I think, Audrey, you know, look, you're in a position where you guys can orchestrate change, or at least have people think about it. I would say that the landscape has to be where we're able to make money on every loan we originate. We need to make more money per loan. We need to bring back servicing and origination so it sort of feels like one. Because the way I did it, because we had to sell servicing at Finance of America, but I had my MSR partners all kept the broker and my originator in the saddle. Yeah. That was me contractually saying, no, we'll do this for you. We'll return the loan to you. We'll do that for you. Yes. And I think you can do that. I think overall, the challenge is, let's don't miss this opportunity that as the mortgage business stays in the shitter, right, with rates being higher and things being paralyzed, right? We don't have enough inventory. We still have a lot of cash, blah, 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 right? Let's don't miss this opportunity to modernize the business. I think people, when they think of non-QM and all this and hard, they think about it in a derogatory way. They think, oh, we're going to do some damage to things. Really? I think it is the only thing that really matters, so that we can modernize guidelines and rules that are so archaic that nobody fits it anymore.
Right.
And I don't fit it. I mean, I'm self-employed. I own 3 big houses. I don't even know where I live. I mean, what's my, if I needed a loan, it would be like, oh my God, it'd be like, you know, I mean, I need Kevin. I need somebody to actually, you know, marshal me through the underwrite, because the underwriter can't figure out my income.
That's right.
And I got plenty of income, but underwriters are really good at compliance.
Yes.
And debt. They suck at income. I mean, they are not, they wouldn't, it's almost like they're on a plank and they're pirates, and we're pushing them out onto the plank. And if they actually said, you know, we're going to add some income, I'd be like, oh, you know, but boy, if you want debt, hey, I'm thinking these people are actually thinking about borrowing money. We should probably hit them with something, right? Well, really?
2 things though. First of all they can think about,
all the underwriters are going to shoot me now.
Well, all they can think about is buybacks and getting in trouble. That's
why wouldn't you? That's
why wouldn't you? Exactly.
Yes, it's
we are so, like you said, what do you think the compliance cost is per loan? Okay, how many times do you redisclose?
Right.
How many times do you mean, how many times you redraw the documents? How many times do you have a change of circumstance? What is an intent to proceed? you've unbundled appraisal costs have gone like this. I mean, an appraisal should be simple, right? It's not that hard. But all of those things.
Well, don't tell the appraisers that.
Cost.
Yeah, exactly.
No, I mean, everybody has a role, and our job has been, I think, with fear, right? We had dissatisfaction, fear, and so much fear that we went all the way to almost over compliance on everything. I mean, the money that we have to give back on a monthly basis to clients in audits and just think of all the vendor approvals you have to do and all the other things that are, it's good to mature your business.
Yep.
And to do it well. And I think most mortgage bankers do that. I think absent fraud, our business is a great industry.
Right.
And I think we work really hard to try to comply.
Yes.
To a bunch of regulations and things that probably don't move the needle. And like you said, Audrey, do you think that's helping a client? I bet you I got at least 100 basis points in compliance costs built into the pricing that's into Fannie and Freddie today. Forget the yield curve and the difference between the two. I bet you there's 100 basis points in there. That's crazy. Is that good for the borrower?
No,
probably not.
Good for the borrower. And there's
no, the prices are so much higher these days.
What?
Prices are so much higher these days than
it's ridiculous.
Well, and you can see the other thing I would say is just to be careful, right? I think in the Midwest and in areas that are heavy FHA, which a lot of my clients are as well, I see FHA DPAs. And so I see a lowering of FICO scores and I see an increase of high LTV lending, especially to clients that are underserved, minority, maybe on the margin, buying a home in an area that's maybe not the best. Okay. Could that be a problem? Yeah. Right. So I think when we look at it, you almost, as a company, the way I have my clients think about it is barbell what you're doing. You have to have high LTV lending for first-time home buyers and purchase. You do, or you're not competitive. Then on this side, you need to be cash out. Right? You need to be good at it. And we're not.
Yep. Absolutely. I want to push back a little bit on this. I really think it is time, maybe past time, for this narrative that the rates are high to shift. The rates are not high. The rates were artificially low for reasons that ended up being really horrendous for our business for the years following those super low rates. So again, I had this conversation again with someone the other day. God, if we could just get to 3. Okay, then, and as I'm beating him in the head, and he goes, okay.
Literally, with a baseball bat too.
No, God, no, I would never do that. Anyway, bottom line is, I told him, I said, listen, don't wish for 3%. Don't even wish for 4%.
No.
If we are literally looking at forecasts in the 6s, yes, they're going to be volatile within a few eighths or a quarter or something, or a half maybe. But we're talking about a very small little amount of volatility. And when we have more consistent rates, and these are historically good, decent rates that we used to think were amazing. I remember when we went down to 6% and we thought it was freaking heaven. It was so much better than what we had seen. It was lovely. So again, we want stability. We want this volatility to be gone. That's what we should be hoping for, so that we have some idea of how to help our clients decide what to do. And again, Bill, for me, this goes back to when I started the business, when dinosaurs walked the earth in 1989, we were really focused on purchases, and occasionally you do a refi. Refis were not driving our businesses. They weren't driving mine. And we really shifted away from this. And now, again, to feed the hungry giants of Wall Street, et cetera, investors, we have to have refis to make enough money to satisfy everybody and to keep.
But you know, rate, it's funny because rate and term have never been really a big part of our industry.
Right.
Right. I started at 20. I remember when it went to single digit, I thought I'd hit a homer.
Yes.
Right. I took a year off of law school. I was going to law school where I started my business. I took a year off of law school because interest rates went to 9. Right.
Exactly.
So I don't think, I think 6, I think 5.5 is a real
Nice.
number, is a
Right.
big deal. And we are going to get there hook or crook, right? Whether it takes the Fed a while or not to figure it out, I think we're going to get there. I think the other piece is that cash out has never been what we're good at because we don't have HELOCs, we don't have seconds really, they're non-QM, we don't have an IO, our investors are still getting used to it. So, and because we have to make money on a transaction basis, we don't make money as mortgage. You want to lose a lot of money, do a bunch of seconds that are small, right?
Yeah.
Because you're not making money at the large loans, you're really
Nope.
going to lose a bunch of money. But I think overall, this next wave is not going to be rate and term. It's just going to be cash out because of need.
Yeah.
That is what we're good at.
Yes.
Renovation, reconstruction, all the things that I said before. I think we've got to create, and what I've always asked the mortgage companies is in their capital markets groups is they're great at agency bullshit, right? They've got all the products, they got all the MSR guys, and so they've got this little treadmill going over here. But if you move away from that to non-agency, non-QM, IO seconds, and so what I've tried to ask each company, and I would ask you guys as well, you have to constantly have a stable of products that enable clients to take cash out. And that's where I was saying, Audrey, before with you and Kevin. So what are cash out? I think there's reverse, there's HEI contracts, there's seconds, closed in, there's HELOCs, then there's IOs, interest only loans, because those are going to be cheaper than 30-year fixed. Then there's a refi. And I think you have to build out a product suite that is ready to go every time. Not, why do we do this to ourselves? What are you guys? And the reason is we're so agency focused, right? And all the things that we do that we forget about times like this. Yes. And I think this is the time for great mortgage originators to take over.
I agree. Absolutely. Okay, so just a few things. In case you've been living under a rock, we have a 90-day pause on the China tariffs. We have gone from 145% down to 30%. Just interesting to note, and this was per MBS Highway, there were 0 shipments from China last Friday. 0 in the US. That is really incredible. So they've also hammered out a compromise of sorts with the UK, 10%. They're going to do, they've taken the imports on the first 100,000 cars, which is about what we buy a year from them, from 25% to 10%. And just as a side note, what the hell are we buying? What cars are we buying in the UK?
Rolls-Royce engines are all we buy there, or those, what do you call those little midget?
Land Rovers, Rolls-Royces.
They were bought by Ford. Okay, we don't have time for this. I keep meaning to check on this, but I haven't. Okay, again, if you have been living under a rock, Fed paused. There is no expectation of a cut soon. Uncle Jerome mentioned the word waiting 22 times in his Fed statement. I don't know if you watch him speak, but I do. It's always very interesting. They don't think there's a cost to waiting, but they also thought that inflation was transitory. So at this point, I'm not exactly sure what the way forward is. And in their defense, it is tough to call it right now.
Because I just want to interject this. I want to interject something about the tariff. So if Friday there was no imports from China, it's going to be a while before we get one.
Well, it doesn't mean they didn't send one on Saturday, so who knows?
It's the length of time it takes to get from China to the US.
That
If
was what
nothing's
they-
coming and nothing arrived, it's not like, okay, they're gonna turn them on tomorrow, they're gonna start showing up tomorrow.
They did
There's
stop tariffs on Friday, Kevin. There just weren't any on that day. Okay.
I understand that part. I'm just saying, don't expect the ships to arrive tomorrow.
Okay, so with all that being said, there was a 10-year bond auction, bond auction last week, treasury auction. And there has been a lot of talk about whether or not there is foreign investors investing in the US still. And the answer in that auction was yes. Yes, they are.
That's what I was thinking.
Participation was strong, so that was something.
Well, it's interesting. I wanted to focus on that too, because there's a lot of talk about how foreign investors are not buying treasury bills anymore. And I'm like, even if the foreign investors aren't buying them, what are people that are turning 65 doing? They're flipping their portfolios over to treasury to be safe. So this crazy up and down stuff isn't affecting it as much because they can't afford to lose their savings. They can't recoup it. So you go into, when you see a lot of this volatility, you start to do more of, let's just buy treasury bills.
So Mortgage Bankers Association did their weekly mortgage applications update, and purchases were up 11% week over week and 13% year over year. Refis were up 11% week over week and 51% year over year. So the question we have to ask ourselves is, are we getting a piece of that as a loan officer? And if the answer is no, that means you need to get up, leave your house. Remember when I used to say this all the time during lockdown, Kevin? Get up in the morning, take a shower, put on some clothes that don't stretch, and go meet somebody. Remember that?
Yeah.
Oh my gosh. That means that we need to be doing things that are outward reaching, and we are communicating with new people and meeting new people and letting people know about all of these programs that exist. And if you have not done that yet, we have a zillion shows you can watch on YouTube, approximately a zillion, on our YouTube channel, Mortgage Pros 411. They're also on the Crispin Commentary website. You can go back and watch, or you can investigate or call an AE that does non-QM, does all these different things, and they're not all the same. There is not one little box of non-QM that you should know about. You need to know about your private investors in your area, because that has come up more and more for me over the last year and a half, 2 years.
And how do you find private investors? You
I
go
go
to your local mortgage events, because that's where they are.
You have to, those are more local in my experience. Bill, do you have another take on that? Do you know private money?
No, look, one of the things that I've uncovered is one of my clients actually is MaxX. MaxX is probably the only exchange in mortgage for non-QM, non-agency. Everybody else is a correspondent. So if you want to get approved, you have to go get approved. You do that. What do you have when you get that? You get a whole set of pricing. You got to upload it into OB. You got to have it in Loan Sifter. Then you got guidelines, documents, and all those other things you got to do. Or you get approved once at MaxX, and it gives you the market, right? I think there are better ways to do non-QM, non-agency than the way we do it. But that's just me, because I have watched mortgage companies just add investor after investor after investor. They don't get any volume. They don't get any pull through. They've got a shitload of exceptions and repurchases, and they generally screw it up because we are not good at adding investors.
I find it frustrating because I'm brokering 99.99% of my business. I find it frustrating that when we run a scenario through Loan Sifter or OB, that we are limited to the companies that we're approved with, because what I want to know is what else is out there. Yeah. I want to know, and the only way to find that at this point is to go to events and meet new people and learn the old-fashioned way, which takes us right back to the beginning, which is join us on Thursday in Thousand Oaks for the Camp Lender Fair. So with that being said, Bill, thank you.
You're welcome.
Really too fast. There's still couple of things that I wanted to talk about, but there we go. Somebody's asking if you're a speaker at the non-QM conference, June 5th and 6th. Do you know what that is, Bill?
Yeah, I know where it is. It's, Kevin, and I'm not, I've been asked. I'm still thinking of whether I want to do it or not.
We're really lucky to have Bill. He is very, very busy. So we always appreciate it when you come and join us. And thank you so much for everything. Everyone, go get a loan. Go get 2 loans. Go get 5 loans. There are loans out there. We need to close them. All right. Have a great week, everyone.
Ciao. See you guys. Thank
Bye.
you.
Thanks.